Hey, what's up, everybody? It is Monday, April 28th. It's going to be already May this week on Thursday. Wow, summer's coming. Had my first watermelon today, man. So I hope you had a nice weekend. So we had a bounce off of some intraday selling. Actually, I sent out an email to my subscribers to buy that dip. I think we're in kind of a, I don't know if you want to call it like a sideways or a kind of a neutral environment right now. I kind of would lean it towards the bullish side because I'm just looking again at the fiscal flows. As I've said so many times, you need to have a compass. You need to have guidance. Those are my instruments. If I'm talking in the parlance of like a pilot or a mariner, the environment could look crazy. It could be hard to decipher. It could be hard to figure out. You got to rely on your instruments. So I go back to the fiscal flows and I see leading flows are very strong. Okay. We've had somewhat of a narrowing in the year over year net government transfers, but that came back a little bit in the last week. I am seeing some increase in fiscal drag that's coming from taxes, obviously the tariffs, okay, and also the slowdown or the decline, I should say, in T-bill interest income transfers. That's actually reaching a point where it's starting to flatten out or even bring down a little bit total interest income transfers. Okay, you got T-bill interest and then you have interest on Treasury securities that comprises the total interest income transfers. That was going up until recently. It started to kind of flatline, and now it looks like a little bit like it's rolling over. So the T-bill interest, and by the way, that's something that I predicted last year. I said when the Fed starts cutting rates, when the Fed cuts rates, it's going to reduce the first thing we're going to see it in, it's going to show up in T-bill interest. And that is happening. T-bill interest transfers are down 25 billion compared to last year. So it's significant. And it may be right now reaching a point where it's dragging down overall interest income transfers. But even so, the two things I mentioned, and by the way, there's individual income tax deposits. That's also now a fiscal drag. I talked about that the last couple of weeks, how it was down compared to last year in December, when we were in December. Individual income tax deposits to the Treasury were down like 45 billion compared to the prior year. Then they shot up to 80 billion over last year. Now they're about 45 billion over last year. So I'm not sure why that happened. I think it was because of some of these tax extensions. By the way, May 1st, which is Thursday, tax day for hurricane affected areas. That's me from last year. So what I want to talk about today is that I'm reading a lot of commentary about how everybody's anticipating big inflation from the tariffs. Prices are going to go up. There's been stories and commentary about supply chain disruptions. So I want to, and I'll be honest, I don't know. I mean, it's easy at this point to say, yeah, man, that's going to happen. As a matter of fact, Stephanie Kelton, many of you probably know her. She's an MMT economist. She wrote an article on her, I think it's like a Substack or something, saying that it's going to be that the Trump tariffs are going to trigger a pandemic era of supply chain disruption. If that's true, that's big time. So, but I don't know. I don't think anyone really knows. I've also read some things where some companies are finding alternatives Some companies are telling their suppliers they will not accept price increases. So I don't know, and I don't think anyone knows, but I admit it's easy to make that forecast right now. But, I'm a contrarian, so like when everybody's making that forecast, I just have a tendency, it doesn't mean I'm automatically gonna think the opposite, but I have a tendency to be skeptical. When everybody is saying, XYZ is gonna happen, I'm thinking, well, maybe XYZ might not happen after all. The one thing I want to point out, which I think it's very important to make the distinction between the pandemic period and now. What you had happen in the pandemic period was actually two shocks that hit simultaneously. One, obviously, was a supply chain that was global. Everything got shut down because of the COVID, and it was a panic, and everything got shut down. And people couldn't go to work, and you know the story. Okay, so that was one shock. The other shock was simultaneously, this happened, a massive, massive global stimulus. Okay, let's just look at the United States because I have data on that, all right? At the end of 2019, that's just before the pandemic hit, because we got hit like it started really blowing up in March 2020. Government spending, top line leading flows were $5 trillion annually. By 2021, it was 7.7 trillion. So in a short period of time, like a year and a half, basically, you had an increase of almost 3 trillion, 2.7 trillion in stimulus. That would be like right now, we're running like at a rate of about 7 trillion plus, not quite 7.7, but let's call it 7.2, 7.3. That would be like right now if the federal government ramped up spending to 10 trillion. All right? That's not happening. Okay, that's not happening. As a matter of fact, depending on what Congress passes in this budget, we might even see a net overall cut in spending. That's what they're talking about. I don't know if that's going to happen, but the best case scenario is that we'll see probably level to what we have right now, which is like 7.2, 7.3 annually, something like that. So back in 2020, 2021, when the whole entire global supply chain was shut down, you had simultaneously, and I'm just talking about the United States, but it happened all over the world. The United States saw almost a 3 trillion increase in government spending. And I ought to mention too, that net government transfers, that's what people call the deficit, right? I don't use that term because it's misleading, it's negative. Net government transfers, that's what the government net transfers to the non-government. That was 965 billion at the end of 2019. That went all the way up to 2.7 trillion. So a threefold increase. That would be like right now, let's say we're running like a 1.5, 1.6 trillion deficit. Net government transfer. That would be like ramping it up to almost 5 trillion. All right? So that's a big difference. I mean, when you think of it like that, you need to have the, look, maybe we're going to get we're probably going to get some supply chain disruption. There's no question about it, okay? You can't, what Trump is doing here, his attempt, and I've been all over this, and it's not even, I don't even feel like talking about it, because I do think it's a stupid idea, at least to some degree. But it's not going to happen overnight. I mean, it's going to take time if you want to recreate a manufacturing base here in the United States to export or whatever. But you're not having those two things happen simultaneously again. I mean, we're not going to see a 3 trillion increase in annual federal spending, and you're not going to see a tripling of net government transfers. I mean, you're just not, okay? And there's a good case to be made that the spending under this new budget deal is going to be, it could even be a little bit less. And same thing with net government transfers. I'll tell you this, the tariffs are reducing net government transfers. Taxes, individual income taxes are reducing net government transfers. Interest rate decline is reducing, and if the Fed cuts again, right now markets are pricing in a cut in June at the June meeting. By the way, the Fed meets is it next Wednesday or the Wednesday after? Something like that. Not 9 days, something like that. Next Wednesday, I think. Or the following, whatever. This month in May they'll meet, but no rate cut is expected. And I should mention also, like, bond yields are kind of drifting lower. That's interesting to me because, like, you look at a day like today, okay, and I usually don't like to ascribe any meaning to one particular day or even a couple of days. I mean, sometimes it could just be position squaring or just noise or a headline or something. But today gold was up, the dollar was down, stocks bounced back, and 10-year yield down to like 421. That's below, the Fed's policy rate, 4.25 to 4.5. So that was interesting. And that's been, I think, like a couple of days now, it's been drifting back down. By the way, the bond trade, if you're curious, it's held up very, very well this year when you look at it against the performance of equity. So, for example, if you were in one of these ETFs like TLT or IEF, that has held up very well, where like the NASDAQ is down 10% year to date. S&P is down like 5.5% year to date. The Dow is down 5.5% year to date. And I think TLT is like flat. So it hasn't been a hedge like gold, but I think it's even better than Bitcoin. It's done better. I mean, it has kind of been a store of value, if you want to, use that phrase. So it hasn't been bad at all. And the Fed is expected to cut. Now, again, I'm kind of like undecided on this inflation thing, because I'm just going to repeat what happened in the pandemic. I think it was wrong for, she said pandemic era supply chain disruption, Stephanie Kelton. She didn't say, she wasn't given a more comprehensive. Well, I didn't read the whole article. I just read the intro because it's a pay thing, and I don't subscribe to her stuff. But I read the headline. Maybe some of you subscribe to her stuff. I don't know. But what I'm saying is, like, again, we had two things hit simultaneously during the pandemic. And that was the global supply chain shutdown and a massive increase in fiscal. I mean, unprecedented. $3 trillion increase in leading spending flows, and a tripling in net government transfers. That's huge. It's enormous. That's not, I could unequivocally tell you that is not going to happen this time. That doesn't mean we won't have price increases, but is it going to be like the pandemic? I highly doubt it. I highly doubt it. The world isn't shut down. There's a disruption in the economic order, for sure. I mean, you don't have to be an economist or a genius to see that. There's been a disruption, a big-time disruption in the economic order that we have been operating under for the last 50 years. But I don't know, like right now, a lot of it is still unsettled. Deals are going to be made. And so I don't know if there's going to be runaway inflation. What I'm doing is I'm waiting to see. And the only thing I do see right now, okay, is some increased fiscal drag from the tariffs, from individual tax deposits, and from the cuts in, from the drop in interest rates. Those are things I could point to in the data. Prices, I mean, so far, if you look at CPI and PPI, it's been tame. Now, I understand the last readings we got didn't really reflect what's happening with the tariffs right now. So we got to wait and see. I mean, it could be a shocker. You know, the April numbers, when we get them, they could be a shocker. And then we'll know. Then we'll like, okay, this is not going very good. So I'm going to wait to see. And by the way, just seeing the April numbers is not really, to me, it's not something that it's a good idea to jump on, to react on, because yeah, we could have one number in April that, and then things could steady out. I think you need to see a couple of months worth of data, but that's up to you guys. You know, I take it all into account: prices, fiscal, you know, and then try to come up with what I think the scenario is going to be based on that. You know, there's a lot of moving parts right now. There's a lot of moving parts. So, and we, you know, we still have the budget that Congress has to pass, right? We don't even know 100% like what the final thing is going to look like. So I think right now we got a couple of things. We got May 1st, which is another tax drain. That's Thursday, but that's going to be much smaller than April. April was like 409 billion. May 1st is going to be smaller. Then we have May 15th, which is a quarterly interest payment. And, you know, since the debt ceiling has been in, in action, or since the debt ceiling has been in effect, these big reserve additions, which the interest payment is going to be, I mean, you know, that's like a 60, 70, 80 billion in one day addition. That's like an 80 billion in one day. These reserve additions, since the debt ceiling has been in effect, they've been negative. That's been a negative for the market. Okay, the bilge pump thing, wave crashing into the boat. Anyway, that's it for today, folks. Please like and subscribe. I noticed like the subscribes have been trailing off, I guess. Some of the content, when I say you got to be tough, you don't like that. And don't forget, go to my website, pitbulleconomics.com. Sign up for 30-day free trial to MMT Trader. I'm the only one who has an applied approach to MMT. All right, I take the concepts and understandings of MMT and I show you how to use that to invest and trade in the financial markets. See you tomorrow. Bye.